Hello, I'm Ben Huneke, Head of Investment Management at Morgan Stanley. Welcome to The Beat with Ben, where we tackle the pressing questions surrounding private credit and equity in today's dynamic market. I'm thrilled to have David Miller, our Global Head of Private Credit and Equity, join us to shed light on these topics. David, thanks for coming.
Thanks for having me.
So tell us, why are private markets such an important part of a client's portfolio?
Historically, private markets have delivered higher returns for investors compared to the public market equivalents. So that's the chief reason. But I think increasingly, private markets are just too big to ignore. They cover trillions of dollars of the economy, and there are thousands of companies that are not public. And so to get a truly diversified portfolio, investors need to approach the private markets, especially as public market shrink relative to the overall economy, to get true diversification. Particularly with smaller companies, investors want to look at private markets.
So if you think about your big market, lots of competitors, how does Morgan Stanley differentiate itself in the private markets today?
Yeah, I think there are a few ways. I think the first is we focus pretty exclusively on the middle market. And the middle market is attractive for a number of reasons. First of all, it's vast, multiple trillions of dollars, tens of thousands of companies. Historically, returns in the middle market have actually been higher than other parts of the private markets. And increasingly, good managers can produce even more outperformance. So that's number one. Now, that's not unique in and of itself, but I think when you combine it with very deep investing teams, a very long history of success investing over 30 years in these markets, it's powerful. I think the biggest reason, though, is really being part of Morgan Stanley, being part of the integrated firm to leverage a whole variety of the firm's power. I like to think of it as large cap resources applied to the middle market.
So you mentioned adding value to companies. So clearly being part of the Morgan Stanley network is helpful, but how do the teams go into these middle market companies and really add value from an operational perspective?
Yeah, that's really key, particularly when you have a buyout of a company, is what do you do with it to improve value over time? And it's really about driving top line growth, driving margin improvement, and driving M&A. So there's just, depending on the sector, you're going to use a lot of tactics that you've used over and over again. And that could entail bringing in a new marketing strategy to increase revenue. It could be doing an entirely new technology upgrade to drive digitization and ultimately efficiencies. It could be bringing Morgan Stanley's ability to find the best executives and bring them into the company to improve as they grow. So there's a variety of tactics that are used to ultimately grow the companies organically, which is one of the biggest drivers of returns.
So a lot going on in the world today, tariffs. Thinking about what sectors your team is focused on in the private equity space in terms of investing and the impact that maybe some of the geopolitical macro environment is having on those sectors.
We invest in a variety of different businesses, but broadly speaking, we focus on services businesses. And that's everything from business services, residential services, healthcare services that focus on optimization and cost containment, as well as software services. The reason we like services are, one, they're capital efficient. So they're capital asset light, capital efficient. They generate cash flows and are generally pretty resilient in downturns. I was looking at a statistic over the weekend. Since 1990, the United States has only had 5 quarters with a decline in spending on services versus 27 for goods. So it tends to be resilient, which is really important because we want consistent growth in the businesses that we own.
Fascinating. So maybe switching to private credit, I'm going to ask the question that's on everyone's mind, it's all over the press. Has too much money been raised in private credit?
So I think the answer is no. If you look at the history of private credit, it's really grown over time. First, replacing banks from the regulation post-financial crisis, and more recently growing and mirroring the growth in private equity, one of the big drivers. And as private equity capital continues to grow, as private equity businesses will continue to come to the market and be sold, private credit is in demand. You also have other trends that are driving the demand, such as asset-based finance. you're seeing a huge need for capital in infrastructure and other digital infrastructure, and that's going to drive demand over the next few years. Now, in the near term, there can be periods where deal flow slows down, and that's what we've seen really in the first half of this year is M&A was slower than expected. So there are periods where you can have temporary supply-demand imbalances, but over the next 3, 4, 5 years, we see the demand for private credit growing, and we're excited about the ability to deploy into that market.
And so how are you seeing clients use private credit in their portfolios when you talk about all the different verticals of private credit?
Yeah, I think private credit and really private assets should always be looked at as a complement to public market exposure. It's not a replacement, it's a complement. So private equity would augment an equity portfolio, and private credit should be looked at similarly. So if you have exposure to broadly syndicated loans, for example, you can get direct lending and get a premium or capture the illiquidity premium, so higher returns for roughly similar type of risk. Alternatively, if you own high yield bonds, there are junior capital solutions in private credit that will get you a premium to high yield. The trade-off is you're often locking up your capital, although the market has evolved to create structures that are not quite as illiquid as they have been historically.
So a lot has been made in the industry around the democratization of alternatives. Maybe just a comment on that, and then do you see the democratization spreading to some of the more newer verticals that you mentioned in your earlier answer?
We do. It's evolved pretty quickly over the last few years, but I think the democratization is really a better way for individual investors to access alternatives, whether it's private credit, more recently private equity, and real estate. And what it is allowing investors to do is, first, there are lower minimum requirements, there's easier documentation, there's more efficient tax reporting, and it also allows for periodic liquidity. But I think the most important point about these structures is the simple or the ease with which investors can deploy their capital upfront, not have to deal with ongoing capital calls and distributions, and be fully funded day one. And that allows them to compound, and it also allows them to get invested day one and get exposure over time.
Yeah, we've seen more and more advisors use those democratized products to be responsible in terms of the way they're allocating capital over time and the way they're building portfolios, and it does allow you to get fully invested day one, which is a big advantage. So maybe before I let you go, one personal question. What's a book you're reading today?
So I just recently finished How Countries Go Broke by Ray Dalio, as well as Our Dollar, Your Problem by Ken Rogoff. And they're similar, but it was really quite timely given everything going on with Liberation Day and tariffs. It really helped you step back and think about some of these really big long-term trends that happen very slowly, and how as investors we should be thinking about the world over the course of decades as opposed to days, weeks, and months.
And what Dalio and Rogoff's take on how dire a fiscal situation the United States is in? What's their take?
I think absent changes, relatively soon, it could get quite serious. But again, no one knows exactly when. I think the saying is, countries go broke slowly and then very quickly.
David, thanks for joining us.
Thank you.
To discover more about David's team and their work, visit msim.com. Thank you for tuning in, and don't forget to subscribe for the latest insights from our investment experts.